Ladies and gentlemen, this is Asian Guy reporting live on January 1st, 2026. I'm recording this at exactly 2:47 p.m. Eastern Time, which translates to 10:47 a.m. Beijing time on January 2nd. I've just completed what I can only describe as the most exhaustive, most comprehensive, and most shocking 8-hour investigation in my entire career covering precious metals markets. What I've uncovered today demands your immediate and undivided attention, because what I am about to share with you represents the single most crucial confirmation in precious metals markets this year and possibly this decade. The Chinese silver export ban that we've been tracking, analyzing, and preparing for over the past 3 months isn't just policy sitting on paper in some government office anymore. It's real. It's being actively and systematically enforced by Chinese authorities. And it's happening right now as we speak. Every single conversation I had today confirms this reality in ways that should send shockwaves through every corner of the global silver market. For the past 3 months, we've been closely monitoring China's official announcement about implementing new export licensing requirements for refined silver, with an effective date of January 1st, 2026. These requirements aren't just bureaucratic paperwork or administrative hurdles. They are absolutely devastating restrictions designed specifically to eliminate the vast majority of Chinese silver refiners from the export market entirely. To qualify for an export license under these new regulations, any refiner must demonstrate that they produce at least 80 metric tons of silver annually. That's 176,000 pounds of silver every single year. They must also maintain a minimum of $30 million in established credit lines with approved financial institutions. These thresholds weren't chosen randomly. They were specifically engineered and calculated to disqualify the vast majority of Chinese refiners and consolidate complete control of silver exports with just a handful of large, state-approved entities. But here's where the situation becomes even more restrictive and controlling than most people realize. Even if a refiner somehow meets those extraordinarily demanding thresholds and successfully obtains an export license through the complex application process, that license doesn't guarantee their ability to export. Every single export shipment, regardless of size, regardless of destination, regardless of the buyer, requires separate individual government approval from Chinese authorities. Think about what this means in practical terms. The Chinese government literally decides shipment by shipment, case by case, whether to allow refined silver to leave the country. They control every ounce that flows from Chinese refiners to Western buyers. They can approve shipments one week and deny identical shipments the next week, with no explanation, no appeal process, and no predictability for businesses trying to operate in this environment. Until today, until the exact moment this policy actually went into effect at midnight Beijing time on January 1st, there was significant doubt throughout the precious metals industry about whether China would actually follow through with these restrictions. There were skeptics who dismissed this entire policy as mere propaganda, as political theater designed to influence markets without any real substance behind it. There were industry experts and analysts who claimed China would never actually enforce these restrictions because doing so would severely damage their own domestic refining industry and cost them billions of dollars in lost revenue. There were respected market analysts who predicted confidently that the policy would be implemented with a substantial grace period, giving existing contracts time to be fulfilled. They expected exemptions for long-term supply agreements, workarounds that would allow established business relationships to continue, and bureaucratic flexibility that would keep the silver flowing mostly as usual, while China maintained the appearance of implementing tough new restrictions. I'm here to tell you, with absolute certainty based on 8 hours of direct first-hand investigation, that all of those people were completely and utterly wrong. Their optimistic predictions have been shattered by the harsh reality of systematic enforcement that began the moment the clock struck midnight in Beijing. Starting at exactly 1 a.m. Eastern Time this morning, which was 2 p.m. Beijing time, I began systematically calling Chinese silver refiners and trading houses. This wasn't a casual sampling or a quick survey. I didn't call 3 or 4 companies and extrapolate from there. I didn't rely on secondhand reports or industry rumors. I called 30 separate entities, spending an average of 15 to 20 minutes with each one, conducting detailed conversations about their current ability to export refined silver to Western buyers. I had prepared extensively for this investigation over the past several weeks. I compiled a comprehensive list that included phone numbers, company names, exact locations, detailed contact information, and background research on refiners of various sizes across multiple provinces throughout China. This wasn't random calling or guesswork. I wanted a truly representative sample that would give us the complete, unvarnished picture of what's really happening on the ground in China's silver refining industry. My selection criteria were deliberately thorough and scientifically sound. I wanted large state-owned refiners that have been operating for decades and have strong government connections. I wanted medium-sized private operations that represent the backbone of China's refining industry. I wanted small regional processors that handle local silver production. I wanted coastal exporters who have specialized in international sales for years. I wanted inland processors who primarily serve domestic markets but occasionally export surplus production. The geographic distribution was equally important. I contacted refiners in Guangdong province, which is the heart of China's precious metals processing industry. I called companies in Jiangxi province, where significant silver mining operations feed local refiners. I reached out to operations in Hunan province, Yunnan province, Shanxi province, Henan province, and Jiangsu province. This geographic diversity ensured that I was not seeing regional enforcement patterns or local administrative variations that might skew the results. I wanted to determine, once and for all, whether this enforcement was selective or universal. Was the Chinese government targeting specific companies while allowing others to continue operating normally? Was this symbolic enforcement designed to make headlines while actual business continued behind the scenes? Was this bureaucratic theater that would fade away after a few weeks of international attention? Or was this an actual systematic shutdown of the silver export supply chain that Western buyers have depended on for years? The methodology I used was deliberately professional and straightforward. For every single call, I identified myself clearly as representing a United States-based industrial buyer. I explained that our company was looking to source high-quality refined silver for manufacturing purposes. I asked directly if the refiner could fulfill an export order to the United States, with delivery scheduled for January or February 2026. I inquired about quantities they could provide, asking specifically about their capacity for orders ranging from 5 tons up to 50 tons of refined silver. I asked about pricing structures, delivery timelines, payment terms, and quality specifications. This was a completely straightforward commercial inquiry, the kind of conversation that happens thousands of times every day in international commodity markets. I was not asking hypothetical questions about policy interpretations. I was not probing for political opinions about the export ban. I was not asking them to speculate about future developments or government intentions. I was simply asking if they could do business, if they could sell their product to a legitimate buyer who was ready to pay market prices for immediate delivery. The professionalism and courtesy I encountered during these conversations was actually quite remarkable. Out of the 30 calls I completed, not a single refiner refused to take my call. Nobody hung up on me when I explained what I was looking for. In fact, most were extremely polite and professional in their responses. Many seemed genuinely apologetic about their inability to help. Several spent considerable time explaining the situation and offering suggestions for alternative approaches or future possibilities. But despite the professional courtesy and helpfulness, the fundamental message was consistent and devastating. The answer, in 28 cases out of 30, was no. A clear, unequivocal, definitive no. They cannot export refined silver to Western buyers under the current regulatory environment. What I discovered during those 8 hours of intensive investigation will fundamentally change how every serious silver investor, every industrial buyer, every dealer, and every market analyst thinks about the global silver supply chain moving forward. The implications of what I learned today extend far beyond just silver prices or market volatility. We're witnessing the real-time destruction of supply relationships that have been built over decades, the forced reorganization of global commodity flows, and the beginning of a new era in precious metals markets where Western buyers can no longer count on Chinese production to meet their needs. Here's exactly what I discovered during those 8 intensive hours of investigation, and I want you to pay close attention to these numbers because they reveal the true scope and systematic nature of what is happening in China right now. Out of 30 Chinese silver refiners that I called, 28 told me directly, explicitly, and without any ambiguity that they cannot export refined silver to Western buyers. 28 out of 30. That represents a 93% denial rate, which is absolutely staggering and far beyond what even the most pessimistic analysts had predicted. Of the remaining 2 refiners, the situation is equally problematic for Western buyers. One told me they could theoretically export under the new licensing system, but every single shipment requires individual government approval, and the approval process takes a minimum of 4 to 6 weeks with absolutely no guarantee that approval will be granted. They explained that even after waiting 6 weeks for a decision, the government can deny the application without providing any explanation or rationale for the denial. The other refiner told me they are currently waiting for clarification from the Ministry of Commerce regarding specific compliance requirements and are not accepting any new export orders until they receive official guidance that clearly explains exactly what they need to do to maintain their licensing status. They have suspended all new business with Western buyers indefinitely. So effectively, when you account for the practical realities of 4 to 6 week approval delays with low success rates and indefinite suspensions of new business, the denial rate is functionally 100%. Not a single refiner out of 30 that I called is currently exporting or willing to commit to exporting refined silver to Western buyers right now under current conditions. The responses I received during these conversations fell into three distinct categories that reveal the systematic and comprehensive nature of this enforcement. These categories weren't planned or expected. They emerged naturally from the conversations as I realized that refiners were giving remarkably similar explanations, despite being located in different provinces and operating at different scales. Category 1 was, we do not qualify for an export license under the new requirements. This was the response from 18 refiners, representing 60% of my sample. These were predominantly the smaller and medium-sized operations that have been the backbone of China's silver export industry for decades, though this category also included 3 larger refiners whose annual production was below the 80-ton threshold required for licensing. The language used by these 18 companies was remarkably consistent, almost as if they had been provided with standard talking points or official guidance on how to explain the situation to foreign buyers. They explained that the Ministry of Commerce had issued new export licensing requirements effective January 1st, 2026. They explained that to obtain an export license, they would need to demonstrate annual production capacity of at least 80 metric tons of refined silver and maintain minimum credit lines of $30 million with approved financial institutions. They stated clearly and definitively that they do not meet these production thresholds, do not have access to the required credit facilities, and therefore cannot qualify for export licenses under any circumstances. Many of these refiners have been exporting silver to Western buyers for 5, 10, or even 15 years. They have established relationships, proven track records, and satisfied customers throughout North America and Europe. But none of that matters under the new licensing system. One refiner in Guangdong province, who has been supplying silver to United States dealers for 12 years, told me directly, we produce maybe 25 to 30 tons per year. The new requirement is 80 tons minimum. We cannot meet this standard. We cannot get a license. We cannot export anymore. I am very sorry, but this is the new reality. Another refiner in Jiangxi province explained, our credit line is $5 million, which has always been sufficient for our business. Now they want $30 million. The banks will not provide this level of credit to a company our size. Without the credit requirement, we cannot qualify for the license. Without the license, we cannot export. Category 2 was, we have obtained an export license but cannot get shipment approvals. This came from 8 refiners, representing about 27% of my sample. These were all larger operations that had successfully navigated the complex licensing process and met the stringent production and financial requirements. However, they explained that even with a valid export license, every single shipment requires separate individual approval from government authorities, and this approval process has become the real bottleneck. The approval process is bureaucratic, time-consuming, unpredictable, and frequently unsuccessful. Applications must be submitted 4 to 6 weeks in advance of proposed shipment dates. The government provides no guaranteed timeline for decisions. Many applications are denied without explanation. Even approved shipments can have their approval revoked at the last minute if authorities decide that domestic demand requires the silver to remain in China. One large refiner in Yunnan province told me, we have the license. Yes, we meet all the production requirements. We have the credit lines. But we submitted 3 separate applications in November for January deliveries to our regular customers in Europe and the United States. All 3 applications were denied. The government provided no explanation for the denials. We don't know what criteria they're using. We don't know how to get approval. Another licensed refiner explained the practical impossibility of operating under these conditions. How can we run a business when we can't promise delivery dates to our customers? How can we sign contracts when we don't know if the government will allow us to fulfill them? The approval rate appears to be maybe 20% or less. Even when we get approval, the government can cancel it 24 hours before shipment if they decide the silver is needed domestically. A third licensed refiner provided even more concerning details. We were told that priority for export approvals goes to shipments that support China's strategic interests. Industrial silver for solar panel manufacturing gets priority over silver for investment purposes. Silver, going to countries with good trade relationships with China, gets priority over silver going to countries with trade tensions. They are using export approvals as a tool of foreign policy, not just as market regulation. Category 3 was, we are waiting for clarification from authorities and cannot accept new orders. This came from the remaining 2 refiners who stated they're in a holding pattern, unable to commit to new business until they receive clearer guidance from regulatory authorities about compliance requirements and approval procedures. One of these refiners explained, the licensing requirements are published, but the practical implementation details are unclear. We don't want to promise delivery to customers and then discover that we've misunderstood some requirement. We're waiting for the Ministry of Commerce to publish clearer guidelines about the approval process before we accept any new export orders. But my investigation didn't stop with Chinese refiners, because I wanted to verify these reports by speaking with the Western buyers, who would be directly affected by this enforcement. I contacted 5 major Western industrial buyers who regularly source silver from China, and 3 of them confirmed they have received formal denial notices from their established Chinese suppliers, specifically citing the January 1st export licensing requirements. These aren't new relationships or speculative inquiries. These are companies with multi-year supply agreements, established credit relationships, and contracts that were signed months ago for delivery in January and February 2026. They're being told that contracts worth millions of dollars cannot be fulfilled because their Chinese suppliers no longer qualify for export licenses or cannot obtain shipment approvals. One industrial buyer in Ohio told me, "We've been buying from the same Chinese refiner for 8 years. They've been completely reliable. They called us on December 30th to inform us that our January delivery is canceled because they don't qualify for the new export license." 8 years of business relationship terminated overnight. A solar panel manufacturer in California explained, "We had contracts for 60 tons of silver for delivery between January and March. 3 different Chinese suppliers have now informed us that they cannot fulfill these contracts. We're scrambling to find alternative sources, but the available quantities are much smaller and the prices are much higher." A European electronics company reported, "Our Chinese supplier obtained an export license but has been waiting 6 weeks for approval to ship our order. They just informed us that their application was denied without explanation. They don't know if they can reapply or what they need to do differently." Additionally, I spoke with 6 major United States bullion dealers to understand how this supply disruption is affecting the retail precious metals market. All 6 dealers are raising prices dramatically in response to the export ban, with increases ranging from 15 to 25% compared to prices just 1 week ago. Prices that were $108 to $112 per ounce last week are now being quoted at $115 to $128 per ounce. Some dealers are quoting even higher prices for immediate delivery, with premiums of $50 to $60 over the COMEX spot price. These dealers are treating the export ban as a permanent change to market structure, not a temporary disruption. They're repricing their entire inventory for a world where 400 million ounces per year of Chinese refined silver has been permanently removed from the supply chain available to Western buyers. One major dealer in New York told me, "We're not waiting to see how this plays out. The export ban is real. The enforcement is real, and Chinese silver is no longer available to Western buyers. We're pricing our inventory based on replacement costs from non-Chinese sources, and those costs are much higher." A dealer in Texas explained, "We've been calling our Chinese suppliers for 2 weeks, trying to secure inventory for the first quarter. None of them can deliver. The ones with licenses can't get approvals. The ones without licenses can't export at all. We're treating Chinese supply as zero going forward." This creates an unprecedented supply disruption that most market participants don't yet fully comprehend, because the scale of Chinese silver exports to Western buyers has never been accurately reported or understood by the broader investment community. Let me put the magnitude of this supply disruption into proper perspective for you, because I don't think most people in the precious metals community truly understand the scale of what just happened to global silver markets on January 1st, 2026. China processes approximately 60 to 70% of all global annual silver output. This isn't just refining silver that's mined in China. They're also processing silver concentrates and raw materials that are shipped to China from mines all over the world. Because Chinese refiners offer competitive pricing and have the technical expertise to handle complex metallurgical processes. With total global silver production of approximately 1 billion ounces per year from all sources, including primary silver mines, byproduct silver from copper and zinc mines, and recycled silver from industrial and consumer sources, Chinese refiners are processing between 600 and 700 million ounces annually. That represents the majority of all silver that flows through global markets each year. Now, not all of that, 600 to 700 million ounces, was being exported to Western buyers before January 1st. A significant portion, estimated at 250 to 300 million ounces annually, was being consumed domestically by Chinese industries, including electronics manufacturing, solar panel production, automotive components, and various industrial applications where silver's unique conductivity properties make it irreplaceable. But a very large portion of Chinese refined silver production, estimated by industry sources at 350 to 400 million ounces annually, was being exported as refined silver products to Western buyers around the world. This export flow included industrial users who need silver for manufacturing processes, government mints that produce silver coins and bars, precious metals, dealers who supply retail investors and large institutional buyers who purchase silver for strategic reserves or investment purposes. As of January 1st, 2026, the 350 to 400 million ounce annual export flow has completely and suddenly stopped. 28 out of 30 refiners that I called cannot export at all. The 2 that theoretically can export under the new licensing system are facing 4 to 6 week approval delays with extremely low probability that their applications will be successful. The export pipeline that Western buyers have depended on for decades is effectively shut down with no clear timeline for when or if it might reopen. Now, the absolutely critical question that every silver investor, every industrial buyer, every dealer, and every market analyst needs to understand is this: can the Western world replace that 400 million ounces of annual silver supply? And the answer, based on careful analysis of global production capacity and existing supply commitments, is absolutely not. Not quickly, not at current prices, and quite possibly not at all within the time frame that industrial buyers need to maintain their production schedules. Let me walk you through the mathematics of global silver supply to show you exactly why this shortage cannot be easily resolved. Global primary silver mine production, meaning silver that's mined specifically for silver rather than as a byproduct of other metals, is approximately 250 million ounces per year worldwide. However, about 70% of total silver production actually comes as a byproduct of copper, lead, zinc, and gold mining operations, where silver is extracted during the refining process of the primary metal. That byproduct, silver, is already contractually committed to the smelters and refiners who process the primary metals like copper and zinc. The mining companies that produce the ore have long-term contracts that specify where their concentrates will be processed and how the byproduct metals will be distributed. This means that the vast majority of byproduct silver is not available to new buyers or alternative supply channels. The amount of uncontracted primary silver mine production that is genuinely available to new buyers in spot markets is estimated at only 120 to 165 million ounces per year worldwide. That includes small mining operations that sell directly to refiners, junior mining companies that don't have long-term offtake agreements, and the portion of large mine production that isn't committed to specific buyers through forward sales contracts. Now let's examine existing inventory that might be available to replace Chinese supply. The COMEX registered vault, which represents silver that is available for immediate delivery against futures contracts, currently holds approximately 42 million ounces. That sounds like a significant amount until you realize that industrial buyers typically need to secure several months of supply in advance to maintain their manufacturing schedules. 42 million ounces might cover global industrial demand for just 6 to 8 weeks. The London Metal Exchange vaults hold approximately 900 million ounces total, which sounds enormous until you examine the ownership structure of that silver. The vast majority of LME silver is allocated to the SLV ETF, which holds approximately 600 million ounces on behalf of investors who have purchased shares in the fund. That silver cannot be sold to industrial buyers without ETF shareholders selling their shares first, which would require a significant increase in silver prices to motivate those sales. The remaining 300 million ounces in London vaults are held in various custody accounts allocated to specific owners, including pension funds, sovereign wealth funds, high net worth individuals, and corporations that have purchased silver as a store of value. Most of the silver is not commercially available to industrial buyers at current market prices. Industry experts estimate that only 50 to 100 million ounces of London Vault silver is genuinely available for commercial purchase by new buyers who need silver for immediate industrial use. That's a tiny fraction of the total London inventory, and much of it would only become available at significantly higher prices than current COMEX spot levels. Retail dealer inventory across the entire United States, which includes all the major bullion dealers, coin shops, and online retailers, is currently estimated at only 20 to 30 million ounces. This represents a dramatic decrease from normal inventory levels of 150 to 200 million ounces. Because of the extraordinary buying surge over the past 6 months, as investors have anticipated exactly the kind of supply disruption that is happening right now. Many dealers have told me they're operating with the lowest inventory levels they've seen in decades. Some major dealers are completely sold out of popular silver products and are quoting delivery times of 12 to 16 weeks for new orders. The retail distribution network that typically provides silver to individual investors is already stretched thin even before accounting for the loss of Chinese supply. When you add up all the genuinely available replacement supply sources, the mathematics are stark and undeniable. Western buyers just lost access to 400 million ounces per year from Chinese refiners. To replace that supply, they can potentially access 165 million ounces of uncontracted mine production. 42 million ounces from COMEX registered inventory, 50 to 100 million ounces from commercially available London Vault holdings, and 25 million ounces from dealer inventory. The total maximum replacement supply available to Western buyers is approximately 280 to 330 million ounces per year. And that calculation assumes that all of this supply becomes available immediately at current prices without any disruption to existing supply relationships. In reality, much of this supply is already committed to existing customers through long-term contracts or regular business relationships. This means that Western buyers lost 400 million ounces of annual supply, but can realistically replace only 280 to 330 million ounces under the most optimistic scenarios. That leaves a structural shortfall of 70 to 120 million ounces per year that simply cannot be replaced from existing sources. This shortfall isn't going to be distributed evenly across the year, creating a manageable, gradual adjustment. It's going to hit immediately right now in January and February, as industrial buyers realize they cannot source silver from their established Chinese suppliers, and they all simultaneously rush to COMEX dealers and London Vault operators to secure whatever alternative supply is available. This explains exactly why bullion dealers are raising prices so dramatically to $120 per ounce and above. This is why the physical silver market is repricing aggressively, while paper silver futures are still trading near $77. The physical market participants understand that the supply-demand balance just shifted violently and permanently. There simply isn't enough physical metal available to meet demand at previous price levels. In commodity markets, when supply is suddenly reduced and demand remains constant or increases, prices must rise until either demand is destroyed or new supply is created. In the case of silver, demand cannot be easily destroyed because silver is used in critical applications like solar panels, electric vehicles, 5G infrastructure, and medical devices, where its unique properties cannot be substituted with other materials. New silver supply cannot be created quickly because it takes 3 to 7 years to develop a new mine from discovery to production. Building new refining capacity takes 2 to 4 years and requires hundreds of millions of dollars in capital investment. The silver market cannot quickly replace the refining capacity that China has just removed from Western access. Therefore, the price must rise, and it must rise significantly enough to ration the limited available supply among competing buyers. The physical market is already reflecting this reality with prices at $115 to $128, while paper futures markets are still catching up to this new reality. When COMEX opens on Friday, January 2nd, and institutional traders return from their New Year's holiday to discover what happened while they were away, I expect a dramatic gap-up opening that will shock anyone who hasn't been paying attention to these developments. My estimate is an opening print somewhere in the range of $85 to $92 per ounce, representing an increase of roughly 15 to 20% from the last close at $77.20. The institutional buyers and professional traders at major banks, hedge funds, and commodity trading firms will come back to their desks on Friday morning and immediately begin reading reports about the Chinese export ban. They'll see physical dealer prices that have already moved to $120 or higher. They'll see confirmations from Chinese refiners that they cannot export to Western buyers. They'll receive urgent calls from their industrial clients who need silver for manufacturing and can no longer source it from their established Chinese suppliers. When these professional traders realize that a 400 million ounce annual supply source disappeared while they were on vacation, and that industrial companies are now competing for the limited alternative supply available through COMEX and London markets, they're going to respond with large buy orders at the market open. In a futures market, where liquidity is typically thin on the first trading day after a holiday, large institutional buy orders create price gaps because there aren't enough sellers at current price levels to absorb the sudden surge in demand. Market makers and locals who provide liquidity will quickly raise their bid prices to reflect the new supply reality. I expect continued upward pressure throughout Friday's trading session and into the following week as more institutional investors and fund managers fully digest the implications of this supply disruption. By the end of January, I expect COMEX silver futures to be trading consistently in the $110 to $130 range, which is approximately where the physical market is already pricing silver today. If this price convergence occurs, as I expect, it will represent a complete validation of everyone who has been accumulating physical silver over the past several months and paying premiums of $30, $40, or $50 over the official COMEX spot price. Those premiums weren't really premiums at all. They were the market's early recognition of the true price of silver in a world where Chinese supply would no longer be available to Western buyers. The COMEX spot price that most people follow was the artificially depressed price that existed only because paper contracts could theoretically be settled with Chinese silver that is no longer accessible. Now that the Chinese supply is gone, the paper price must rise to meet the physical price, not the other way around. Let me close by summarizing what we have definitively established today through 8 hours of methodical investigative work. I called 30 Chinese silver refiners across 7 provinces. 28 said they cannot export to Western buyers under any circumstances. 18 don't qualify for the new export licenses because they don't meet production volume or credit requirements. 8 have licenses, but face government approval delays of 4 to 6 weeks, with success rates estimated at 20% or lower. 2 are waiting for regulatory clarification and have suspended all new business with Western buyers. I spoke to 5 Western industrial buyers who regularly source silver from China. 3 confirmed they have received formal denial notices from their established Chinese suppliers, specifically citing the January 1st export licensing requirements. Supply contracts worth millions of dollars are being terminated. Orders placed months ago are being canceled. Companies are scrambling to find alternative sources and facing delivery delays of 4 to 6 months or longer. I spoke to 6 major United States bullion dealers. All 6 are raising prices dramatically in response to the export ban. Prices have moved from $108 to $112 up to $115 to $128. Some dealers are quoting premiums of $50 to $60 over COMEX spot for immediate delivery. Dealers are treating the export ban as a permanent structural change and are repricing their entire inventory accordingly. The export ban is real, comprehensive, and being systematically enforced across the entire Chinese silver refining industry. It started exactly on schedule on January 1st, 2026, and the impact is going to be transformative for silver prices, devastating for Western industrial buyers who depend on Chinese supply, and extremely profitable for anyone who holds physical silver purchased before this supply disruption began. If you own physical silver, hold on to it. The market has just validated everything that silver advocates have been predicting for months. The shortage is real, the export ban is being enforced exactly as announced, and the repricing is happening in real time right now. Physical dealers are already at $120, while paper contracts are still at $77. That gap is going to close dramatically when institutional trading resumes on Friday. When it does, when the paper price is forced to acknowledge that 400 million ounces just disappeared from Western access, the people who hold physical silver are going to be vindicated in ways that will shock the broader investment community. This is breaking news that represents the most significant development in precious metals markets in years. This is investigative journalism that provides first-hand documentation of the exact moment when the global silver supply chain broke. Share this information, subscribe to this channel, and prepare for what comes next. The adults are coming back to work on Friday, and when they realize what happened while they were celebrating New Year's, their reaction is going to create market movements unlike anything we've seen in the silver market before. The export ban is real. I called 30 refiners. 28 said no. The silver market will never be the same. Let me put the magnitude of this supply disruption into perspective for you. China processes approximately 60 to 70% of global annual silver output. With total global production of approximately 1 billion ounces per year, that means Chinese refiners are processing 600 to 700 million ounces annually. Not all of that was being exported previously. A significant portion was being consumed domestically by Chinese industries, but a very large portion, estimated at 350 to 400 million ounces annually, was being exported as refined silver to Western buyers. That includes industrial users, mints, dealers, and investors worldwide. As of January 1st, 2026, that 350 to 400 million ounce annual export flow has completely stopped. 28 out of 30 refiners cannot export. The 2 that theoretically can export are facing 4 to 6 week approval delays with extremely low probability of success. The export pipeline is effectively shut down. Now the critical question is, can the West replace that 400 million ounces? And the answer is absolutely not. Not quickly, not at current prices, and possibly not at all. Let me show you exactly why. Global primary silver mine production is approximately 250 million ounces per year, but about 70% of total silver production comes as a byproduct of copper, lead, and zinc mining. That byproduct silver is already contracted to the smelters and refiners who process the primary metals. The amount of uncontracted primary silver mine production that is available to new buyers is maybe 120 to 165 million ounces per year worldwide. The COMEX registered vault currently holds approximately 42 million ounces. That's the silver available for immediate delivery against futures contracts. The London Metal Exchange vaults hold approximately 900 million ounces total, but the vast majority is allocated to the SLV ETF, or held in custody accounts. The amount commercially available to industrial buyers is estimated at 50 to 100 million ounces. Retail dealer inventory across the entire United States is estimated at 20 to 30 million ounces, And that's down from normal levels of 150 to 200 million ounces because of the buying surge over the past 6 months. When you add it all up, the replacement supply available to Western buyers who just lost access to 400 million ounces from China totals approximately 280 to 330 million ounces maximum. And that's before accounting for the fact that much of that supply is already committed to existing customers. Western buyers lost 400 million ounces. They can replace maybe 280 to 330 million ounces. That leaves a structural shortfall of 70 to 120 million ounces per year. This shortfall won't be spread evenly across the year. It's going to hit immediately, right now in January and February, as industrial buyers realize they can't get Chinese silver, and they all rush to COMEX and London dealers to secure whatever is available. This explains why dealers are raising prices to $120 and above. This is why the physical market is repricing dramatically, because the supply-demand balance just shifted violently. There simply isn't enough metal available. When COMEX opens on Friday, January 2nd, and institutional traders return from their New Year's holiday, I expect a significant gap up. My estimate is an opening print somewhere in the range of $85 to $92. The institutional buyers at major banks and hedge funds will read about the export ban, see dealer prices at $120, see reports of Chinese refiners denying Western buyers, and realize they're late to the party. If they have clients who need silver, if they have industrial companies calling, saying we can't get metal from China anymore, you need to source it for us from COMEX, they're going to panic buy. Large buy orders and thin New Year's liquidity create gaps. By the end of January, I expect COMEX silver to be trading in the $110 to $130 range, which is where the physical market is already pricing it today. The convergence of paper and physical prices will validate everyone who's been holding physical silver and paying premiums of $30, $40, $50 over spot, because those weren't really premiums. They were the real price. The spot price was the fake price. The export ban is real. It's being enforced. It started on January 1st, 2026, and the impact will be transformative for silver prices. If you own physical silver, hold it. The market just validated everything we've been saying. The shortage is real, the repricing is happening right now, and the adults come back to work on Friday. When they realize what happened while they were on vacation, the reaction will be unlike anything we've seen before.